Hello, I'm Arvind Chari, Fund Manager for Quantum Liquid Fund and Quantum Equity Fund of Funds at Quantum Mutual Fund. We've had the government presenting the union budget for the fiscal year 2013-14, and we're here to discuss about what was positives, what are the negatives, what we liked and what we didn't like in the budget. Going purely by the market reaction, it seems a case of misguided expectations, because you've seen both the equity as well as the bond market falling quite sharply from the levels of yesterday or from the morning levels. Basically, we've had this view for a very long time that budgets are not any big market boom, market changer. It used to be in the past where budgets used to be a historic event and it used to be sort of a game changer. But over the last few years, the budget has lost its significance in terms of being a big market changer. Looks like that the market were expecting a bit too much, and maybe the finance minister has not lived up to the expectation. That's why you see in the market reaction. From our point of view, we were looking at three very key things: that the challenges that the Indian economy faces, and whether the union budget could in some way sort of address those issues. The biggest thing was the investment cycle. We've seen a big drop in investments and capital formation in the country, and which has resulted in the fact that GDP growth is now slipped down to below 5.5%. We were looking at some measures in the budget to revive or aid or the increase in the investment cycle. We've seen some bit. We could have seen a bit more. The second thing, obviously, which is a bigger factor to worry, is the overall savings. If you see financial savings as a percentage of GDP has gone down to 8% in the last year, and people's investments into equities has fallen even more. So this is a very worrying sign where investors and savers in the country, we do have a lot of saving, but that savings is not going in the financial markets, and it is maybe going in the real estate, and more recently in a big manner into gold. We were looking at some measures to ensure that savers get back into are incentivized in some way, that they get back into the deposit market, or at least, and especially in the equity markets. We were a bit disappointed in that, and I'll talk to you about why so. The third biggest factor, which is again a macro concern, was on the fiscal deficit and inflation. By capping the fiscal deficit at 4.8% of GDP, the finance minister has sort of addressed that. 4.8% of GDP fiscal deficit is still a very high number, but it is still lower than what we had in the last 2-3 years. So in that sense, a move in the right direction. Overall, I would say that this was a sort of a neutral budget, neither very good, neither very bad. In terms of whatever they have put out in terms of numbers, I think they're achievable. The government meet all its revenue targets and most of its expenditure targets. And so the commitment of maintaining fiscal deficit at 4.8% GDP, I think, will be maintained this year.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.